there's so many different angles to take a look at the real estate market. You have executives from publicly traded companies, you have folks that manage REITs, and then you also now are going to have Rich Anderson, who is the managing director, equity research at Wedbush. Rich, welcome to the show. How's it going, Rich?
Real good. How bad can it be?
It depends. It depends on what your views on real estate are, which we'll get to here in a moment. But for the folks that might not be familiar with what is it that you do, give us a quick brief overview before we dive in.
Sure. So I'm an equity research analyst. My job is to be as smart as I possibly can on the real estate investment trust space, REITs, and to be a resource for money managers and anybody who's involved in investing in the REIT sector. So essentially, that's my job. And however I do choose to be smart in the space is essentially up to me. As long as I, follow the rules, and I'm, happily following the rules. So, but essentially, I'm a resource of information for people that are interested in the space.
Well, there's so much happening, right? You've got the election cycle happening and the interest rates, what's going to happen on that side. But just give me your thoughts on the overall real estate market as of today.
Sure. So, there's a lot of, sort of outside influences and thoughts about commercial real estate. Certainly the banks have been influenced by their exposure to commercial real estate, namely office. When we look inside the sort of four walls of the REIT space, there's a lot to be excited about, actually. We have a questionable macro environment. But when you think about the REIT industry, it's about 180 different companies separated into 15 different property sectors. The vast majority of they're doing quite well fundamentally. So whatever influences we see from some outside sort of lines of sight into the space generally are opportunities for these companies that are very well capitalized, great balance sheet, great management. So we're fairly excited right now in the REIT space today.
And then do you see the interest rate cuts, no matter which way they swing, having a big impact on the real estate sector? Or do you feel like no matter what happens, it's already kind of priced in?
No, I think they will. But I think it's a flash in the pan type of thing. I think what has happened for the REITs and their underperformance as of the last couple of years has been a lot of question marks around interest rates. And as we sort of get into more of a range-bound world on the 10-year Treasury and anything from a macro point of view, then we could start to talk again about the real fundamentals of real estate. To this point, they've been, swished around because of the movement in the interest rate environment. We're starting to see some clarity there. We're getting into a range-bound 4 to 4.5% range on the 10-year, and that's good for the REITs. So once we have some stability there, we should be off to the races about talking about fundamentals and comparing property sectors and creating some alpha.
Well, you might see some volatility. You mentioned how stability is a good thing for the REIT side, but you might see some volatility. So if the interest rates are cut, what impacts do you see on the real estate side? What opportunities do you see there?
Yeah. So first of all, overall, it would be a good day. If we have 100% probability of a rate cut in September, that should be a good day for all the REITs. They'll be up that day. But then you start to think about where do I find my best opportunities in a sort of a lower rate environment? And it's probably in those sectors where they're a little bit more leaning into the dividend yield as a total return component to the story. So healthcare REITs, triple net REITs, gaming REITs. These are all companies that are much more leveraged to the dividend yield in terms of the opportunity set as it relates to those companies. And so, broadly speaking, good for the REITs. But then when we dive into it, it's those companies that really offer a bigger yield that would be the beneficiaries in a rate cut environment.
Well, you're talking about the REITs, you're talking about opportunities. So let's talk about the four that I want to get some insights from you from. One of them is going to be Vici Properties, ticker VICI. Then you got Ventas, ticker VTR. Healthcare Realty, ticker HR. And then Boston Properties, ticker BXP. Give me some insights on what these four are.
Sure. So Vici, we'll start from top to bottom. Vici is a triple net. You've heard me mention earlier, triple net REIT, which means they essentially collect rent. And that business model, meaning they're not really involved in the operations of their businesses, underlying businesses. They're simply a passive sort of collector of rent. Vici has a humongous portfolio of casinos, and they own 10 or 11 literally on the Las Vegas Strip. So that's the Venetian, Mandalay Bay, MGM Grand, so on and so forth. It's a really exciting underlying business, and Vici captures that essentially through a rental income stream. It's a big company, $31 billion market cap, and has grown through M&A over the past couple of years. So the trick for them is to how do they grow externally off of such a large base, and so that's the question. They are moving outside of casinos lately into experiential real estate, so indoor water parks or golf courses, so that they sort of continue this experiential element to the story. But it's primarily a casino story, and it's exciting, to be honest with you. These are huge, chunky assets that people can really relate to. So it's a quite a good story.
Yeah, on the Vici properties, one, I'm curious if I invest in it, if I get a nice hotel room for free. But you also have so much, expansion happening in Vegas with sports teams and Super Bowls and events happening in Vegas. I mean, the Spear, the ball, the ball looking thing. I mean, I'm excited to see that next time I go to
Yeah.
donate some money. Let's talk about Ventas, ticker VTR. What is that?
VTR is a healthcare REIT, $21 billion market cap, known primarily for its investment in the senior housing space. And so here they are actually involved in the operations. The revenues and expenses of the underlying business are on the books of Ventas. So it's very much an operating model. They also own medical office and they own life science real estate. But this the prospects for Ventas will be driven by senior housing. Senior housing is in the midst of a major post-pandemic recovery. Occupancies got dismantled during the pandemic, and they're trending back up, and Ventas is participating in that upside. So it has the makings of a very interesting story, particularly when you look at the birth rates from 85 years ago. All those people are now moving into senior housing, or potentially moving to senior housing. So the demand is very strong. There's limited new supply. So we're excited about Ventas as an opportunity to capture this aging population dynamic in the U.S.
Okay, so I got what Ventas is. Tell me what makes Healthcare Realty, ticker HR, different.
So they are exclusively in the medical office business, or we call them MOBs, and these are the buildings that either are on the campuses of hospitals or just outside, where you would go and see your doctor or get an outpatient procedure or get X-rayed or whatever it is. And so the good thing about medical office is you're benefiting from the push to get people out of the expensive hospital into a more cost-effective environment to get procedures done. And so that's the business model. It's a fairly visible cash flow stream for healthcare realty. And again, here largely involved in the operations of the business, not just collecting rent. And to the extent that aging population dynamic I just spoke of is going to spend more and more in terms of healthcare costs, you would think HR would be in a good spot. They are currently absorbing a recent merger that they took one of their peers over in 2022, and that's been a choppy ride. So we're a little cautious on HR for the time being, but over the longer term, you would think medical office would be an interesting play for investors.
Yeah, I think that's always going to be a need and in demand thing. And then lastly, Boston Properties.
Yeah, Boston Properties, ticker is BXP, $10 billion market cap. So Boston Properties is an office REIT, and it's a very, very high-end office REIT. The best trophy assets in the country are owned by Boston Properties. They've named themselves BXP because they're not so much in Boston anymore. They're all around the coastal areas of the country. The office business is a tough business. This is a great company and a difficult business that has been made more difficult because of the post-pandemic, work from home, all those things. Do we really need office space? But what Boston Properties, or BXP, is benefiting from a flight to quality. So tenants, are in a position of negotiating leverage, and they're saying, well, I don't want to be in this Class B asset anymore. Now I could be in this beautiful building with all these amenities, and I can get it for maybe a bit of a discount. That's the plan for BXP, and frankly, it's working for them. But the office business in general is a tough one, and will likely be a tough one for the foreseeable future, as we all try to figure out what's the real need for office. Boston Properties is a big fish in a small pond. Let's call it that.
Yeah, I'm not always on TikTok, but when I am, I love seeing the beautiful high-rise buildings. I'm like, you know what? Yeah, if I worked here, I could be rich. I could make it in the world. So that's exciting to hear about Boston properties, and especially how they've expanded outside of just Boston. It's
Yeah.
been a pleasure to talk to you, but I wanted to give you the floor, Rich. If there was anything else that you feel like viewers should know about when it comes to the real estate market.
I do want to say something. I mentioned Boston properties in the office space. Oftentimes, people associate office with the entirety of commercial real estate. Just not true. Office as a sector represents 3% of the total REIT industry. The other 14 asset classes, as I mentioned earlier, are largely doing quite well fundamentally. So when investors look at the REITs, keep in mind, don't get hung up on what's going on in the office space. Look more deeply into it, and you'll find some really good asset classes as we've been describing.
Awesome. Got it. Thank you so much for your time, Rich. I appreciate it.
You're welcome. Thank you so much.
You got it. That is Rich Anderson, Managing Director, Equity Research at Wedbush.